Today, we are setting up our class. We're actually going to be talking about and exploring Investments 2.0. All right. A couple of years ago, I took a course called Rule 1 Investing, which helps you really get the basics about value investing. And the cool thing about that is we want to invest, what I learned at least, is that we want to invest in things that we believe in. We want to invest in the companies that we believe in. The biggest thing that people don't understand about investing is funding. Okay, when you're investing in a company, you're funding that company. You're saying, I like this, I believe in this, and you're voting with your dollar. All right, you're voting with your dollar to say, I want more of this. And so you should be very aware of what exactly it is you're investing in. You should be very conscious of the things you're helping to fund, because that ultimately is going to help us build the future that we want or build the future that we don't want, respectively. All right, so you need to make sure that you're properly investing in the things that you believe in. And today we're going to be going into just a little bit of value investing. Now, value investing, there's a couple of different things. Let me actually show you guys this real quick. Because as I set up my class, value investing, this is Rule 1. It's a course that just goes really, really deep into how to invest. And one thing that I really like, if I can hop to this page quickly, is this graph right here. Okay, we want to focus on the things we're passionate about, things that we're talented in, and things that make us money. If you focus on investing in those three areas, your chances for success are so much higher, all right? And today with my students, we're going to be going really, really, really in depth. I try to take as much as I could that I learned in this course, as much as I could, and condense it into 3 30-minute sessions to give these grade 12 students, the stewards of our future, the folks that are going to be really taking control of our planet in the future. I'm trying to give them a crash course so at least they have the understanding, they have the language, and they know exactly what to look for to find success in these spaces. But with that being said, lunchtime is almost here, so I will see all y'all in a little bit. Maybe I can get a couple more snippets for y'all to check out, but that's pretty much it. I'll talk to you later. Peace. How dare they? Yeah, that's. I tell you, it's always frustrating, but. Okay. Okay. Y'all's ready for today? Are y'all's ready for today's session? I don't think anyone's the thing. Yeah. Honestly, I had like to work on this essay. Yeah. It's the end of the school year, and we gave you more homework. It's totally not fair. So it's totally okay if you didn't. I wanted to show y'all this first real quick. No. This is what I'm trying to squeeze into 2-3 days. Okay? Wow. This is the course you could put through it. I spent $4,000 to do this course. Okay? And I'm sure this is why I'm like, how much information can I just quickly share with y'all to give you some language, okay? That's hard work. It is a little bit tough, but there's some key components that I found in here that I'm trying to make sure that it makes sense, right? The key components in this, I want to make sure y'all get those at the very base, at the very least. Y'all want to sit on this side? You're so far. So far away. Okay. So with that being said, I saw some other folks here, but maybe they went to the wrong room. If you have the numbers of folks that you know are part of this, feel free to text them. Hopefully they can make it in and can join today's session. All right. With that being said, let's just jump into it. As usual, we always have this code up here just to say, I think all of you are in this, so I wouldn't really worry about this. I have a riddle for you again, although you can see everything. This is not good. This is not good. Not a garden, but I'm still a kind. In the market, my growth you'll find. What am I?
Kind of like a garden.
Kind of like a garden, yeah, sort of.
The things grow in a garden.
Yeah.
It, in the market. What is the first letter start?
I can't tell you. You'll know it right away. But just in the interest of time, the answer is, huh? Tech
Oh,
investments again. Yes, it's in the bottom there. I was hoping that y'all wouldn't see that, and um, I'm glad you didn't see that one. Okay, so we're gonna continue getting started with value investing. All right. I did have a little bit of a recap for y'all's. This is gonna be part three, not part 3 and 4. I tried to squeeze the two in, but it's just not a thing. Maybe we continue talking about investing next time. Maybe not. All right. But first, I did want to say the two things you should get away from today. Get from today is getting started and your preparation. Kind of the same thing, but very different at the same time. All right. Now, I want to review something real quick. Can anyone tell me some of the key principles we talked about last time? There's 5 of them. So we did. That's one of the technically one of the principles, but one of the topics. But yes.
oh, buy when things are on sale.
Buy when things are on sale. Yes. What are some other key principles we may have talked about? About the market in general.
You buy when people are emotionally buying.
Okay, so technically, yes, I'd say that is the psychology of the market. So we talked a bit about that. Okay, and another one y'all remember?
Something about like how.
Okay, don't even worry. The next one we have is intrinsic value. So when we say intrinsic value, it means something is really worth something on a deep level. It's not just everyone saying it, so that's what it is. Like it's actually worth something. All right. The next thing we're gonna, and I don't know why these slides always do this to me. I always try to make it so it's not doing this, but margin of safety. This is where we are buying it on sale. It ties into the intrinsic value. We're gonna go deeper into margin of safety today. We have long-term holding. Okay, we want to buy things we're gonna hold for life. Okay, or as long as possible. Awesome. So glad you guys are here. Grab some pizza, take a seat. And I'm it's perfect you're here right now because I'm doing a bit of a recap of last week. You guys were on the field trip last week, right? Yeah. So I'm doing a bit of a recap just to show you all some stuff. So market psychology, intrinsic value, margin of safety, long-term holdings, and discipline. Those are the key principles that we went over last week. All right. And what exactly is value investing for y'all? Value investing at its core, it's picking assets that appear to be trading or selling for less than they're actually worth. Okay, it's buying things on sale. And the when we're doing value investing, we're assuming that the market is overreacting more times than not, right? And we want to buy it once again. When it rains, it pours. We want to be scooping up everything when the market is down. Okay, one of the books that I told you also to get last week was The Intelligent Investor by Benjamin Graham. This is the person that taught Warren Buffett what he knows, and a lot of other folks that were in the same camp as Buffett, what he knows, right? Da, 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 da. Keep it moving. One quote. This is a quote from Warren Buffett. The most important thing is to be able to define which companies you can make an intelligent decision about. And we're going to go much deeper into that today. That's going to be the biggest focus of today. So, the first thing I want to tell y'all is, and I'm going to start asking questions after, but investing is funding. Now, what do I mean when I say investing is funding? What might I mean when I say investing is funding?
Funding for the company that you're investing in.
Yes, yes. So when I say investing is funding, that means the money you're investing to buy that stock is helping that company operate. Okay, you're funding that company and saying, I believe in this company, I want it to go somewhere. And so because of that, there's a couple things that I want you to keep in mind. Make sure your values match the values of the company. All right. If you love the trees and you love nature, right? Don't invest in a company that's cutting down trees. It doesn't make sense, right? So you want to make sure that it matches things. And there's a couple things I want you to think about. I want to see if I could actually fix these slides real quick. I think I have to sign up for the MITM Club Financial Education courses. Links down below. We're good to go. We're gonna jump forward again because we had a little bit of a hiccup there, and we're talking about finding your sweet spot. So once you actually have your sweet spot and you have a couple companies listed there, like you mentioned Sony. What was the company for you? Nike. Okay. company comes to mind for singing? Is it certain microphone? I mean, singing is kind of you can do it anywhere. Maybe we look at another one. Is there a certain paint brand that comes to mind?
Certain paper.
Yeah.
There's this,
Hi, welcome.
I don't know the name, but I do like pastel.
You like pastel paints? Okay, so there's going to be certain pastels and certain pastel paints. Okay, so once you have your company, whatever it might be, okay, that is in your sweet spot, the next thing you want to do is you're looking for a strong moat. Okay, now what is a strong moat? And I have a castle here, and you can't really see the water, but there's water around the castle, and it's to protect the castle. Oh, yep, that's always great. It's to protect the castle from being invaded. That's what a strong moat is, right? And when we have a moat in a company, there's 5.5 key moats that we're going to look at, okay? So something that protects companies and what lets you easily take your competitors' money and your competitors' profit clients, right? As terrible as that sounds, business is war, okay? It's territorial, it's war at the end of the day. You're trying to get as much stuff in your pockets as you can while taking as much from your competition as you can. That is business at the end of the day, right? But you can work together with folks, but you probably get acquired eventually. So there's 5 of them. The first one is brand. Now, y'all's mentioned some brands, right? And maybe a brand that comes to mind is Nike, right? You mentioned Nike. So Nike as a brand is a strong moat. The brand is not going anywhere. Whatever happens with Drake, or whatever happens with one specific shoe, whatever happens in general, it doesn't matter. Nike is not going anywhere as a brand. Okay. Next thing that we want to look at is price. There's a couple companies we might look at for price, but anyone go to Dollarama here? Yeah, is there a reason? It's nice and cheap to get stuff there. So we might think of Dollarama as one of the things to say the price is lower than other places, so I'm going to go to Dollarama. I got to save me some money. Okay. The next one we're looking at will be secrets. What do I mean when I say secrets? Well, for example, Tesla has a way that they make their cars that is different from everyone else. They have some secrets. They started doing battery technology. They have some secrets, right? Although they're giving away a lot of information. Another example could be like Coca-Cola, right? Coca-Cola, no one knows the recipe. Everyone's trying to figure it out. That's a secret of theirs. And they actually keep that in the lock and key because they've trained their clients and their customers to love the flavor of Coke. So why are they going to change it ever or do anything, right? That they keep that. Another one is a toll bridge. Now this one might be a little more confusing, but when you hear toll bridge, what comes to mind? Could be, yes. But specifically with that bridge, it's like you have to pay to go across. So you could think of an actual bridge you pay to go across, or it, hmm? Exactly, yeah, like the toll highway, you got to pay to take the highway, or something like when I say toll bridge, I want you to think of a monopoly, okay? A monopoly, which means that you don't have any other choice but to take their stuff. For example, Trans Canada, right? They deal with energy and they deal with oil production across Canada. If you want to get into oil, you're going to have to work with them eventually. There's no choice. There's nothing else. Or I mean, before when it was the Canada Post and it was just the Canada Post, you have no choice but to use Canada Post. Okay, that's toll bridge, and you can invest in those companies. All right. Another one we have is switching. Okay. Does anyone know an old person in their life that like has everything Rogers? Like Rogers phone, Rogers internet, Rogers TV, Rogers security house system. And I was gonna put Rogers and Tollbridge because there's only 2 phone companies in Canada. It's Bell and Rogers. You don't have a choice. You pick one or the other. So if you're gonna invest in a phone company, it's one or the other. Really, they own every single other. Because I think Bell owns all the phone lines, and then they rent out space to everyone else to use their phone lines. Right? It's a monopoly. But to switch from this, like my grandma, I've been trying to get her to say, Grandma, I can set you up with a Wi-Fi security system without paying Rogers. I can set you up with an Android box. I can set it like internet keeping for that, and your phone, just those two, and I can set up everything else without dealing with Rogers. And in fact, we can move over to Tech Savvy or something cheaper for you instead of you paying hundreds of dollars every month. It's ridiculous how much you're spending, right? Instead of doing all that, I can say, let's switch, but it's a lot for her to switch. And so switching is another moat that a lot of people don't consider. And lastly, we have another switching, okay, another type of switching, but this is, for example, Google. Has anyone heard of any other search engines outside of Google? Brave, oh, that's a browser, right? Yahoo, yep.
I think it's called DuckDuckGo.
DuckDuckGo. I was surprised. I was gonna mention that. I was like, I don't think anyone of y'all is gonna know that, but DuckDuckGo, yeah, or Bing, yeah. So these are some. A lot of people would rather just use Google because they're so good that switching wouldn't make sense for them. It's more difficult. Okay. So when we look at all of these different things, these are the moats that we want to look for, and we want to see if we could find two or more, ideally three or more, for the companies that we're interested in. Okay, because if you do that, that company is not going anywhere. At least now you know that if something bad happens, right, and we're going to talk about that in a moment. If something bad happens, they're going to recover because they have a strong moat, and no one else can come into that industry in that sector and take what they have because they have a strong moat or multiple moats, right? No one's catching up to Tesla. They have secrets, they have brands. The price is not the best, but switching from Tesla will be difficult because you have the supercharger networks, you have the Tesla car, you have whatever, right? Rogers, they have their brand, the pricing is terrible, they don't have secrets, they have a monopoly, and they have a bunch of stuff. Switching from Rogers is going to be difficult, okay? So they're going to be pretty good. Damn, I got like 6 minutes left. Are you kidding me? Okay, there's three different methods of evaluating a company or evaluating an investment in general. Today, I'm only going to be focusing on the 10 cap. Okay, the other ones are a little more complicated. The 10 cap, I can give you the math really quickly to go over so y'all can kind of get an understanding of that. So first, when we think about 10 cap, there's a certain mentality. And I've been saying this over and over throughout this session so you guys can start to get what it is. Is it simple to understand? Can you understand it? This is why we want something that's in our sweet spot. Okay? This is why we want to have something, well, mainly in our sweet spot and our realm of understanding. Okay? Does it have a strong moat to protect it? Right? Does it have two, three, does it have all five of the moats to protect it? If so, cool, that's a really good sign. Are you almost certain that it'll be more in 10 years, worth more in 10 years than it is now? Like for me, I think Tesla is going to take over the car industry in the next 10 years, 100%. It's already kicking butt. And from my last 10 years of predicting, I'm very much correct. And I want to see what the next 10 years are going to be. So seeing it on sale right now, I'm very happy. But I'm like a nerd for Tesla. I watch shows. There's a thing called Tesla Time News I watch for fun because I love Tesla that much, right? You want to find things like that in your understanding that you're like, oh, 100%. And then does it currently produce a return of at least 10%? If all of these make sense and then you see 10%, that's a 10 cap. You can say, oh, this is going to make me 10%. Some years it might drop down a little bit. Some years it's going to be better. But 10% return is what you're looking for at the very least. All right? So this is how you calculate your 10 cap. How much cash is there after operating the business? Okay? Whatever the business is. Remove the capital expenditure required to maintain the business. So you're going to take how much cash is after operating, then take away the capital expenditure, right? Then you're going to determine the owner's earning annually before taxes. And then if it's 10% or more, then you have a 10 cap. And all of that sounds complicated, but I have it written out for you here. Okay, it's very simple. In a rental property, money comes into the rental property first, right? Whatever the rent is. Then you have to take away insurance, property tax, landscaping, garbage removal, maintenance, and you have your total expenses for operating the business, right? So this minus this equals your net income. Then you take away your capital expenditure, which is more, we're not going to go into capital expenditure, that's kind of more complicated. But like a quick overview is like, no, that's too complicated. If you want to Google capital expenditure, feel free. But we would look at that next, right? And then you see your actual earnings. And if this earnings shows you that you're making 10% per year or more, good investment, grab it. Okay? At the very least, this is the most simple one to look at. The other two are more complicated, so we're not going to go into them. Lastly, what we want to look for are different events. Okay? Yeah? Oh, yeah. And I'm going to, yeah, take a picture of this. Feel free. Feel free. The next thing that we're going to go into is talking about different events. Because if you do all of this research and you find out all this stuff about the company, but it's trading really high right now, you're not getting it on sale. So how do we get it on sale? Like right now, Nike's dropped. From the last time I looked at it, it's like back to $90. So when I bought it for 93 and I sold it for 150, it's back at $90. I could buy it again and do the same thing. Like I can keep making that $60 spread on Nike because I know the company and it's not going anywhere. So I'm like, it's on sale. It's on sale $60 right now. That's great. I just found that out earlier today. I'm a lazy investor. I won't look at my investments. automatically set certain things. So I'm gonna buy some more Nike just now, right? But what we're gonna look for is some events that are gonna happen in the market. So maybe a huge disaster happens, like an oil spill. Everyone's going to be angry about the oil industry. Everyone's going to hate oil for all of 6 months. And then they're going to realize they need to drive their car to go places and keep buying oil. So the stock is going to drop because everyone's like, oh my God, oh, so bad. Maybe it's for 1 year, 6 months, 1 year, 2 years, maximum 3 years. Okay. And we're thinking long term investment already. So I'm like, it's down for 3 years. Will it still be worth more in 10 years? Probably. Is everyone afraid right now? Probably. So it's time for me to buy because no one believes in this thing, right? That's one event that can happen with a specific company. Another thing that can happen is an industry-wide event. Okay, this is so the last one was the oil spill. This is like one. I forget what company it was. Do you guys remember the oil spill that happened down in the Gulf of Mexico? What was that company called? I forget the company. But anyways, that company when that oil spill happened, their stock crashed. But because their stock crashed, it was an industry-wide event at the same time. All of the oil stuff went down. Oh no, the Gulf of Mexico, the poor baby birds, the pictures of the Dawn soap saving the birds and stuff. Everyone's stressed out. So oil went down. It's terrible. But that's an industry event. And you could say, oh, now everything in this industry is on sale. Oh no, industry wide, there was some silliness that was put in this one cream. This one ingredient that almost everyone uses in their cream made everyone sick. This industry is down. Okay? Or right now, like the housing market. The industry is there's a bubble that's about to happen. The whole industry is going to be down. Okay? And if you look for that industry wide event, you're good. Then we want to look at economic events. Like the biggest economic event that has happened in our lifetimes is COVID. Like the way that the stock market, everything in the stock market dropped by 25% for all of less than a month and then spiked back up. Crazy. Okay, things were on sale during that time. Okay, one more thing. So as we close out, and this is, I'm trying to, like I said, trying to. Mr. Nicoletto, Ms. Hensley, and Ms. Zeiger for your 4 classes, please report to the cafeteria. Ms. Zeiger, Ms. Hensley, and Mr. Nicoletto for your 4 classes, please report to the cafeteria. Okay, so just to remind yourself, pay yourself first. Rule 1 is don't lose money. We're trying to buy things on sale, so we don't lose money.
Mr. Report class, please report to room 220. Mr. Pimentel, report class, please report to room 202.
The best. So we're doing everything in a way that we're buying things on sale, things we know are going to work, things we understand, right? Buy wonderful companies at wonderful prices. Always looking for that sale, okay? And we're buying people's fear and selling them back their greed. That's pretty much it for today's session. Cool. I'm glad that I pretty much got it in 30 minutes. As usual, please scan this to give me some feedback so that your principals and teachers and everyone will know if you love or hate the program. Next week. Is that it? Okay, next week. next. I think we already talked about insurance. I don't remember what we're talking about next week, but it's going to be about something. Maybe we go a little bit deeper on investments. If not, there's going to be some other topics. But thank you guys for coming by. Thank you guys so much for checking out that free training. Make sure you smash the link down below to join the Money Mastery Dash. It's another free training for all of you. And to all my students, thank you so much. You guys are amazing. I hope you have a great summer. And check out the next video. We have another amazing video in store for you. So check out the next one, and I'll see you on the other side. Peace.